Hi everyone, this is John O'Legas, and I'm going to use these four graphs to try to communicate concepts that relate to employee stock options. Okay, now what we're looking at is the components of a perhaps typical employee stock options. We're assuming here that 1,000 options were granted to somebody of ABC Company with an exercise price of 20 because that's the price of the stock on the day of the grant. We're making other assumptions that go into the calculation of the value of the option, like the volatility of the stock. We're also making an assumption of the risk-free interest rate. Here we're assuming 5%, which is much higher than what the interest rate is today, but there was times when that was not that high an interest rate. We're also assuming for these graphs, instead of the maximum contractual life of 10 years of those options, we're assuming 6.5 years of expected time to expiration. We're also assuming that there's no dividend. So with those assumptions, 1,000 options are worth, on the grant date, $8,290. Okay? If a year later, perhaps, the stock goes to 30, you now have what's called intrinsic value, equal to $10,000 because you have the right to buy 1,000 shares at 20. But you still have this time premium or time value. They call it time value in the employee stock options arena. Guys that on the floor of those exchanges trading as options market makers would call that time premium. Okay, but if the stock is trading at 30 and it's 5 years expected time remaining, you have $6,114 of time value or time premium, which, if God forbid you followed the advice of some advisors, you made a premature exercise, you forfeit that time premium and you get to pay an early tax too, which will be illustrated on following graphs. Okay, now if indeed you held these options and you were very fortunate enough to have the stock go up 100% after maybe 2.5 years, 3 years, and you still have 4.5 years expected time remaining, because remember, we started off with 10 years of contractual life. If the stock went from 20 to 40, those options that had a theoretical value of $8,290 when you were granted them have a theoretical value of $24,524. Okay, so as you can see, the value has increased quite a bit. Now let's suppose you're interested in reducing risk. How do you do it? The companies and the wealth managers want you to make that early exercise, forfeit the time premium, and pay the early tax. But now, let's look at the next graph to see how, if we make different assumptions about the volatility and other factors, how that changes these values. Okay? So here we have the same concepts. We're showing the two components of employee stock options. We have different assumptions about volatility. We're assuming here a much higher volatility of 30%, although the interest rate assumption of 3% is less than 5%, and that assumption of that lower interest rate does have a suppressive effect on the time value. And the expected time remaining, we're assuming slightly less also, which has a suppressive effect on the time value. The increased value because of the much higher assumed volatility makes the time premiums or the time values much larger than on the previous graph. Okay, so as you can see, the intrinsic values don't change as a result of the change of the assumptions. The only thing that changes as a result of the change of the assumptions about volatility, dividends, expected time, remaining interest rates affects the time premium. The exercise price does in fact affect the intrinsic value, because intrinsic value is defined as the stock price currently subtracted by the exercise price. So if you have the right to buy it at 20 and it's trading at 40, you have $20,000 in this case of intrinsic value. But you still have some time premium, which if you exercise under these circumstances is forfeited back to the company. All right, let's go to the next graph. All right. So here, all we've done is we've taken the first graph where we're assuming that lower volatility, higher interest rates, 6.5 years time to expiration, no dividend. We're just showing what happens if you exercise net after taxes. If you have the right to buy the stock at 20 and you're fortunate enough to see it go to 50 with still 3.5 years expected life. In other words, if it takes you 4 years to get up there, which is rare. You know, it only happens maybe one chance out of 15, something like that, depending on the volatility. But it could happen, and if you have the right to buy the stock at 20 and it goes to 50, you have a nice big profit. You do still have time value, which is forfeited if you exercise. Plus, if you exercise and pay a 40% tax on income, you got to pay that $12,000. So you get net after taxes $18,000 for something that's worth $33,000. In California, you can get less, because California the state taxes plus the federal taxes jump the current tax on your employee stock options up to 45%. All right. So now let's look at the final graph, which is the same as the graph before, except we changed the assumptions with the high volatility, giving us that much larger time value. All right. Now let's suppose you've studied these graphs and now you understand to a substantial degree the value of those options on the grant date, the value of the options as the stock moves around and time passes, and the consequences upon making early exercises. And you might conclude that if you have the right to buy the stock at 20 and it's trading at 40 and there's a high volatility like 60, you don't want to forfeit that $6,460 in time premium, and you don't want to pay that early tax, which makes it such that you're getting less than half the value net after taxes to diversify. You might say, well, is there any other way for me to manage these whereby I can lock in some of that profit or reduce the risk? And the answer is 100% yes, you can do it. You can go to the exchange traded options markets, that is the CBOE or the ISE, and you can do offsetting trades, or you can do trades in those listed exchange options markets to offset the risk that you have in your positions with these employee stock options. Right? For example, you can sell calls, or you can buy puts on a smaller amount. All right. Now, which calls you sell and which puts you buy and how many calls you sell and how many puts you might buy all depends on your attitude towards risk and how much protection you want. Okay? And what your view might be of what the future is of the stock. Of course, if your view of the stock is that it's going to go back down because you don't think it ought to be as high as it is, and you don't have any inside information, of course, but you just, in your mind, think it's overpriced, then you might sell more calls than you would sell otherwise. I mean, if you sold, if the stock went from 20 to 40 and you're still quite bullish, but you want to reduce risk and take a little off the table, you could sell partial number. You might sell 4 or 5 calls for every 1,000 shares of stock that you have, or options that you have on 1,000 shares of stock. You may sell the calls with an exercise price of 40 or 45 when the stock is trading at 40. And you might sell just a portion. You won't give yourself full protection on the downside, but you will give you some protection. And if you're still bullish on the stock, then that might be what you want to do. You still maintain your alignment with the company to a large degree, but you bought some insurance, and you'll actually, if the stock just sits there, you'll actually earn income by doing that. Okay? The income is generally going to be capital gains. So if you have offsetting capital loss carry forwards, you might even be able to make some tax-free income. Now, okay. Now I can demonstrate that by doing this efficiently, you will maximize the value of your options. You will reduce your risk. The idea of making early exercises, selling the stock, and diversifying is promoted by the industry. It's promoted because the companies get a big benefit when you make that early exercise, because they receive the forfeited time premium, and they receive cash flows from you buying the stock from the company, which they issue new shares, and they get a tax deduction equal to what you're claiming as a income. All right? So that's why the companies want you to make these early exercises. They don't want you to maximize the management, because it raises the cost and it delays the flows. One of the reasons of issuing these options from the beginning is to maintain their cash and increase their cash flows over time. So if you are holding these things to the end and reducing risk, you are in fact raising the cost of the company, because you actually increase the benefits to yourself. Now, the wealth managers don't want you to do it either. They don't want you to manage these things this way, because they want assets under management. And they also have conflicts of interest, because large wealth managers are also investment bankers. And they're promoting the interests of the companies and the top executives. And if you're just a manager, they couldn't care less. Okay? Now, again, we've looked at the concepts by looking at the components of the employee stock options. That is, time premium and intrinsic value, and how it changes over time and as the stock moves around. The only efficient way to manage these things is to try to reduce the risk when it gets the greatest. The risk of holding employee stock options is greater when the stock's 30, if you have the right to buy it at 20, than it is if the stock's 40 or 50. Okay? All right? Yes, the absolute risk is greater when the stock's 50 as opposed to 30, but the options themselves are more volatile when the stock's 30 than when the stock's 50. And that is what determines risk. And if you're a fiduciary, you have a responsibility towards your employee to understand and advise the reduction of risk. And if you don't do it, you could be liable for violating your fiduciary responsibilities. Anyway, I'm going to close with that, and I hope you enjoyed it, and thank you for listening, and I hope you get something from this.